All right, everyone. It is James Dainard with Heaton Dainard Real Estate. We are going to get going on this market update again. So we do these every month. We do a 30-minute quick presentation. Obviously, we're not going too granular because this is sorry, something just popped up in the chat feed. So that threw me off a little bit. Sorry, guys. So we're going to be doing this every month. The reason being is we just want to keep you up to date what the latest trends are. We're going to keep it short and concise. We're going to go through the presentation. Then we're going to open it up for 30 minutes of questions answering. Every month we cover the same core principles, which is going to be inventory in the three markets: King, Snohomish, and Pierce County. So jump right into this. Who am I? And what we've been doing is I've been a full-time investor with my partner, Will Heaton, since 2006. We've been buying and selling properties through all different types of markets, whether it was 2007-8 crash, we had a slowdown 2018, but we've been in all sorts, up, down, flat markets. But we've been buyers in every market. We don't really get cold feet on that. We have flipped over 2,000 homes with my business partner, Will Heaton, over the past 19 years now, and we've been involved in over 3,500 real estate transactions with our investor clients, working them through the disposition and underwriting and analyzing those deals. In addition to, we've done over $1 billion in direct sales to investors. So we are active real estate investors and brokers that specialize in value add construction, whether it's a BRRRR property, fix and flip, or development, and constantly looking at new ways to find opportunities in this market. So what we're going to cover today is a 2022 first recap. I like to recap what happened in that first half. The reason being is that's where we saw all the massive acceleration in appreciation. That's kind of why we're in this little bit of a mess right now. What we saw is a massive increase in values in the first two quarters, and then we're seeing a pullback right now. We're going to cover King, Snohomish, and Pierce County. If you're outside those counties, I apologize. We're just kind of tight on the window, so we keep to those main three. We're going to talk about interest rates, inflation reports, and investment trends that we're seeing right now and buying. We are current buyers in the market right now. We purchased roughly about $15 million in deals in the last 30 days. So bring us your deals. We are still looking to buy, especially large multifamily development sites, fix and flip. Bring it all to us. We are looking at everything. So let's recap the first half, and we'll do this quick because we all knew it was great, right? So what happened during that first half is the median home price in King County jumped up to almost 900,000, 890,000. That's about a 10%, it's a 13.8% increase in a very short amount of time in a 5-month window. And we saw that kind of accelerated jolt up. Pierce County, the median home price went up to 575, which was a 15% increase year over year from in May 2022. And Snohomish County went up to 780, which was a 20% appreciation jump at that point. So we saw this rapid accelerated appreciation, which at the end of the day, as investors, made us all look really good, right? When we were going to sell these properties, they were selling for a lot of money. We were making a lot of money. It was very easy to move deals for wholesalers because the market was so red hot. There was no inventory that honestly investors had a lot of FOMO and they were buying a lot of any type of asset. So those days are kind of changing right now, and we're getting into a more normalized, stable market, which is totally fine. It's actually the better way to invest in. It's just you have to run your metrics and your numbers right. So what does that look like? That means tracking the trends, right, and seeing what's going on. So in this So currently in King County, we are at now a medium home price of $795, which is still up 7.4% from on a year-over-year average, right? So the market is actually still up 7.4% from last year, which is a healthy growth. That's actually more than a healthy growth. Typically, if you look at the last 50 to 60 years of real estate, the average appreciation rate is about 3.5% to 4%. And so we're double what a normal rate is as of this month. But where it kind of hurts is we're up 7.4% as of today, but back when we were just looking in those May stats, that we were up almost 15 to 16%. And that's where we've seen the drop. We've seen a 7.5%, 8% pullback, which is what is compressing all of our margins. Pierce County's is the median home price is down from 575 to 495. So that's about a 10% pullback since we've seen in that peak market. And it's actually put us at a negative 1% depreciation for the year over year. So Pierce County has now kind of hit its wall at that point. And Snohomish County has dropped from the 780 medium home price down to 742, which is an 8% increase year over year. So again, we've seen a 12% pullback from where it was back in the spring. So current market conditions right now. So home prices in Washington are still up 4.2% year over year in October. So again, we've had 4.2% year over year growth. That's actually totally normal, but it is down about 10 to 11% on median home price from where it was in May. We have seen a more of a rapid drop with the, obviously rates got increased at the highest it's ever been, and we've seen a rapid pullback. That makes sense, right? If the Fed and interest rates go up at the highest speed it's ever seen, we're going to see the negative result at that sign. But we are starting to see things kind of stabilize out and hit where the affordability factor is, and things are starting to trade and not drop quite as quickly. Uh, Median home price is now at $599 nationwide or statewide. Days on market have increased to 31 days, 106% increase over where it was year over year. So now, on average, it's taken 31 days. Back in the spring, we were looking at more 12 to 14 days in those tri-counties. So we've seen a double increase in time. That means, as an investor, you want to adjust your hold times, pack in more interest carry into your deal, and then buy accordingly off that. That's really all that means at the end of the day. You want to target deals a little bit cheaper. And in addition to the reason why we've had longer days on market is the supply has increased 105%. Now, that 105% seems like a much scarier number than what it actually is. I think prior in March, we basically had about 2 to 3 weeks worth of inventory right now. So right now we're seeing about no, it was statewide, it was about a month worth of inventory. So we've seen that double. Um, uh, and because we've seen that double, that's where it looks like 100%. Right now we're more at like 2 months of inventory in the market. So 2 months of inventory in the market is actually historically low. Typically, we have to get to 4 to 5 months of inventory to start seeing depreciation. So the reason we're seeing the pullback in the depreciation now is just pure cost of money, and we're getting to that magical sweet spot. If inventory remains at 2 to 3 months, we're going to be looking pretty good, because that's still half of what it really should be. And so, those are things to really keep your eye on. So in King County, this is our core county that we work in, at least, inventory is up 157.9%. Same thing what I kind of referenced earlier. King County actually had about 2 weeks of inventory in. Now we're looking about 7 to 8 weeks worth of inventory. So we've seen that increase. Numbers of sales have dropped, though, dramatically. So that's just showing the activity in the market is slow, right? And buyers are confused right now. They don't know where rates are going to go. The Fed is usually, when Jerome Powell comes out, he's saying a couple things, and those things are that we're going to keep increasing rates throughout the next 2 to 3 quarters. So what that means is people are just nervous, which is really making everything on pause. There has been some really good opportunities because the transactions are down, though. Because there's less transactions, sellers are starting to get a little bit more nervous. There's more opportunities in the market. But yes, sales are down 40% year over year. Days on market are up to 26 days, 116% increase from where it was year over year. And original list price, we are seeing homes sell for about 6.6% off of the original list price. So when you're looking at homes in King County and you're looking at actives and pendings, you can kind of bank in that 5 to 7% off list price right now if it's priced and kind of sitting on the market. And 50% of the homes sold under asking price in the last 30 days. So buyers are being opportunistic. They want a better deal, and they're offering lower offers at this point. So Pierce County inventory is up 92.6%. So not quite the same amount of increase, but that's also because they had about 3 to 3.5 weeks of inventory. They weren't quite as low on inventory as King County was. Numbers of sales have decreased even further, at 42% of sales in Pierce County we are down 42%. And so the reason we're seeing a little bit less transaction even in Pierce County is because the interest rate effect has a real impact on those first-time home buyers. A lot of King County, they're still trading out houses. They still have equity. They're still putting a lot of money down, in addition to They have jumbo rates in a lot of King County to where they can actually get a lower interest rate. Is in Pierce County, the median home price is a lot lower, don't qualify for jumbo. So that's why we're seeing the transactions slow down a little bit more there as well. And then days on market are up to 29 days, up 107% year over year. And on average, homes are selling for actually surprisingly less. Or less of a drop than what King County is, and it's a 0.27 drop compared to roughly a 5 or 6% drop in King County. The reason I think that's actually happening is because there is still buyers in Pierce County. The pricing is still affordable, and people can still buy close to rent prices even with the rates right now. And so the buyer doesn't need that extra drop off list price to get it to be affordable for them. What we're seeing, the transactions down, is there's just less qualified people. The economy is not quite as good. It's not as strong. The job growth isn't as strong in Pierce County. So there's less transactions going on. Skipped Snohomish County. And then Snohomish County, to kind of back clean up. So inventory is jumping quite a bit, up 200% from where it was up year over year. This is pretty common when you go into a transitionary market. Typically, when you get further out and you get into more rural areas, which Snohomish County has a ton of rural areas, so does Pierce, the faster inventory is going to increase and things are going to depreciate a little bit quicker or pull back a little bit quicker, right? Because historically, people pay more money for properties that are closer to your metro areas. The further away you're out, the more market impact you have, and the less they're going to sell for. What we saw because of COVID is a mass demand for bigger lots and to be a little bit out of the city. That made Snohomish County jump at 20%. And so what that means is because Snohomish County blew up so quickly because the demand of what people wanted during pandemic times, it's pulling back a little bit more with more people are bringing more homes to the market. So if you're in Snohomish County, definitely check your inventory levels. That's growing even quicker than the King and Pierce. Numbers of sales have decreased 36% year over year, and days on market are up 138% with an average of 31 days. So as you're looking at your next deal in Snohomish County, factor in that 30 to 45 days on hold cost, not including your time to close. Because if it's at 31 days as days on market, you still need an extra 30 to 40 days to close that deal. So if you're underwriting anything in Snohomish County, you want to probably factor in for a good 2 months worth of hold cost in there. And then original list price, it's selling on average at 7% below market. And you guys, there's a lot of good questions coming in. I will be answering these all at the end too. So they just feel free to keep slamming those questions in, and we will answer them all at the very end. So what are we doing as an active broker shop? We stay very active in the market. We typically sell between 100 and 150 million a year in investment property that's been stabilized. So right now, what we're seeing is an average showing of about 3 to 4 showings a week. If we're on our listings, if we're getting less than that, that is concerning, and we're looking at price adjustments if we're 1 to 2. But if we're getting that 3 to 4 showings and we're priced in the middle of everything, we're not too concerned. So if you are going to sell that property and you get a low amount of showings, but it's just around 3 to 4, that's actually pretty normal at this point. So don't freak out. We are seeing a lot of people kind of cut price rapidly, and it's having very low impact. You have to be patient as the days on market go up to 30 to 45 days, and they could go to 60 days fairly soon. You have to be patient. You need to own that price when you roll it out. Don't get irrational. So just kind of work your buyers, make sure there's that steady flow coming in. If it starts dropping below everybody else, start making adjustments. Currently, we have about 45% of our listings pending. I think that's we have about 22 pendings and about 25 actives. We're getting really good showings throughout all of our listings. We do feel like we're at a point to where we don't need to price adjust much right now, and we're getting things sold. Average days on market right now for us, because we are in the flip market or the development market, we're selling stuff at the upper echelon of the market, not the median home price. So our average days on market are trending about 15 days higher than what the median home price is. And that's fairly normal, right? The good thing about having renovated property or brand new built properties, you have a lot less objections, right? If people also are trying to save their liquidity right now, so they have a higher monthly payment, they get to buy something turnkey, they're happy about that. They don't have any more cash to come out of pocket on to do any kind of renovation. But that also means that you could be waiting longer because you are at the highest, most expensive product usually in the market. It takes time to sell that stuff. So be patient. The things you want to be really doing is talking to all the brokers in the area, figuring out what the showings are, and seeing if they're getting the same amount of activity. If you are sitting at market for 40 to 50 days and everybody else is trading at 20, you're going to want to look at maybe your price needs to be adjusted. And then right now, we're very on trend with what the median pricing is doing. Is we're selling stuff for about 5% off list right now. Now, that doesn't mean all of the houses. That depends on more how quickly you want to move the products. We're selling stuff under list when our clients want to move things quickly and they want to get out of that hard money payment. If we're patient, typically we're more around 2% off of list price at that point. So now that we kind of went over the inventory, we're going to talk about interest rates, inflation, and the economy. Those are the things that are going to drive whether how long this is going to last or not. So good news is inflation, even though it's up year over year right now, it is going below the trend. So in September, the inflation hit 8.5. In October, the CPI was reported at 7.7. So it is trending down. Now that 7.7 is still up year over year. I think it's roughly up. I think it was like 0.5% or about 1% higher than it was year over year. But there's some factors in there that are kind of kicking in at that point. There's some stuff that was in year over year. I think about a year ago, there was some less supply chain issues that made it, the CPI was actually underreporting at that time. So we're actually kind of looking more average, and that's a great sign, right? Because what the federal government and the government wants to do is slow down this inflation, make sure it doesn't erode our all of our economy. And in addition to, they're trying to get the labor market down, right? Because interest rates are bad because it affects our sellability. But what this is actually doing is it's going to make it a much more balanced market. The labor costs we've been paying for the last 12 months to contractors is ridiculous. We are going, guys that we used to pay 25 bucks an hour are now asking for 50 bucks an hour. That is a huge increase. And not only that, a lot of these guys aren't even technical trades at 50 bucks an hour. That is over what the market has historically done. So as the interest rates start battling back this economy, the labor market is going to settle out and we're going to be able to reduce our construction costs. But the biggest thing about this inflation report is the Fed was actually expecting a 0.6 increase from for this month in October. It came in at 0.4 instead of 0.6. So it came under their expectations. What that means is we could see Jerome Powell back off these interest rate hikes if it keeps with that trend. We want to see how next month does, but if it does it again, that's a good sign that rates are going to stabilize out. And that's all we really want in the market. I don't really care what the rates are. I just want to know that they're not going to be moving all over the place as I'm trying to stabilize and dispo off property. If the rates are stable, you can run your numbers and metrics a lot more logically. Markets are now, one thing the Fed has said, and we all need to keep our eye on this, is markets right now are braced for a March 2023 at 5% from the Fed rate. Right now, we're about at 3.75 roughly. So the Fed is talking about bringing the cost of money up to 5% from where it's at. That's 1 to 1.5% higher than it's at right now. That's where rates could keep going up. In addition to, that's going to slow our economy down. Now, we could see that the Fed was bluffing a little bit because if the CPI continues to kind of trend down, that's where they might back off that. So really pay attention to those CPI numbers and then what Jerome Powell is saying every time he talks. So right now with the interest rates, we are seeing a 40% effect on affordability. That is huge. So if you were looking at a home that, let's say, we're going to a math example in a second on this. If you're looking at a home that's let's say 100 grand, you're going to pay on your average cost of mortgage, you're going to pay 40% more. And that is really detrimental. And that's why we've seen this slowdown. I mean, if you grab those random listings, you throw in the mortgage calculator, you will see that the monthly cost is just dramatically higher. Once this stabilizes out, people get used to that kind of monthly payment, and then it's going to be where it's going to be. And we're going to continue to see a little bit of a pullback until we hit that sweet spot on affordability. The reason we've seen such a dramatic effect is we have seen larger increases than expected. At the beginning of the year, the Fed told us they were going to do 4 to 6 hikes that were going to be about a half point. Now we're into hike number 5, and we've seen 3/4 point hikes. So that has accelerated this substantially faster than what they were telling us at the beginning of the year. Today's the good news is rates were up to 7.5, and the federal fund rate was at 3.75. It is to 4%. They said they're going to increase it more. But we saw interest rates fall from about 7.5 or 7.25, 7.5 to 6.9 after the inflation report rate came out. That's because these banks are listening to what Jerome Powell and the Fed are saying, and they built a lot of these 3.75 or 4% into their rate. Also, when banks hear that the Fed is saying that they might take the rates to 5%, they're going to build that into pricing to protect exactly what they're trying to protect their investment portfolio and their banking. So because they see a little bit of a pullback, they drop the rates down to 6.9. We could see rates kind of settle down around this pricing. Banks need to work their money too. And so they don't want to overprice, because if the demand falls too much, they're not going to be able to make their transactions. So keep your eyes on the inflation and federal rate. Um, at the end of 2022, what they are anticipating is about another 3/4 point hike is on the horizon. October, that could go to a half point for what I'm hearing. So again, keep your eye on it. October rate increase was 3/4 of a point, and the Fed rate is to be over 4 points by the end of 2022 and 3. So they are going to continue to go up. So what does that look like with the math on display? And I think this is important to see. So if you bought a home that was $1 million in January at a 3.25 rate, and now at 6.9, you're roughly paying $2,200 more a month. That is a big deal. With a single family rental property right now, for 5 units and above, sorry, this is a typo, this is 1 to 4, but it's 5 units above, your rate would be 5.97, which is going to make an increase of roughly about $1,200 to $1,500 on that payment. So we've seen a less jolt in the commercial side because the rates have had a less increase from where they started to where they're at now. So the impacts of these rates, you guys expect longer market times. We are no longer going to be selling homes in 5 days unless you're pricing aggressive. You need to build in at least 30 to 60 days into all your hold times. Be on the lookout for irrational price drops. If you have a home listed and someone cuts price 200 grand and they go pending, that can have a massive effect on you. Watch for the domino effect. If no one else cuts price, you're probably okay. But if people start cutting price, you want to stay in front of it at that point. And buyers are being very selective. Make sure, as cost of money goes up, their monthly expenses go up. As people spend more money, they take more time to think about things. I was just talking to the buyers that bought my home in Bellevue recently, and they've been looking for 2 years for a house. And it took them 2 years to find that magical house, and they bought it with a higher rate, but then they kind of beat me up on price because the rate was so high. So there are buyers out there. They've been very selective. They didn't buy just to buy. They wanted what they wanted. So if you have a really special property, it will click out. And then showings have reduced 90% in the last 90 days. So again, you guys just stay with the trends. It's not a big deal if you're not getting showings, as long as you're at where you're supposed to be. So what are we doing at Heaton Dainard? So things that we're doing is, like I've kind of mentioned, we've increased our hold times by 2 to 3 months on almost every deal. So that just factors in the extra 2 to 3 months of carries. We absorb it into the profit and adjust our strike prices accordingly. We're adding 5% contingencies to all cosmetic fixers. We're adding 10% contingency to all major fixers. The reason being is we just want that extra padding in the performa. We do believe the construction is starting to fall. I've already seen some pretty massive price drops. And we've seen some, like for example, a couple painters I used to work with, now they're working for me again. They're down 30% on their paint costs. We put a temp pole up at one of our townhome sites, and within 2 to 3 days, that pole was filled full of business cards for people that are trying to get work. So as it's not an overnight thing, but we're starting to see that as the market gets cooled down, as cost of money increases, transactions slow down, right? We've seen in all counties, it's down about 40%. That means the demand for construction is also starting to fall. There's usually about a 6-month lag in there. So in the next 4 months, we might see a dramatic drop in construction costs. So you need to, as an investor, make sure that you are negotiating. Don't just take that price. Is it logical? Is it with the current market trend? And adjust and talk to your contractors. Let them know what's doing and drive that pricing down. If you can't drive down the pricing down and you can't put the right plan in play, you're not going to buy a deal. We're only using cluster comps. We are not using those one high random comps. It doesn't matter if we have a comp for $1 million, but all the rest of them are sitting in the low nines. We're going to go with that low 9 number. We're only using 60-day recent sales. We want to stick to homes that are selling with similar interest rates. Even if we go back to August or late July, the rates were about a point cheaper than they were at today. That's a 10% affordability factor. So don't go too deep into your comps. They're kind of irrelevant at this point. And then we're putting a heavy emphasis on pendings and actives. We want to know how many showings they're getting, what the activity is, how many offers they got, where they're trending at list price, and then we can adjust our back end numbers down the road. Um, and that's the important thing is you're looking at any deal pro forma from anybody. Where's the data points? How close are they? How tight are the comparables? So over the last 2 years, people are stretching out their comps a lot more because there was such a lack of data points. They're there now. So use your close comps, use similar architectural styles. Don't cheat, don't ballpark it, use actual data facts. That's where you can make all your adjustments and really button down your numbers. And then we've increased our returns about 16 to 20% with leverage on each deal. Reason being is things go sideways. There could be a little bit of a market pullback still. We want to make sure that we're padding that into the pro forma. The numbers we were all buying at on returns and expectations returns were really tight the last 2 to 3 years. The reason we had to do that is the market was ripping so fast and we were making a ton of money on the appreciation. At Heaton Dainard, we never factored appreciation in the deal, but we would buy a deal at a slimmer margin in a better neighborhood, right? Like just like in multifamily, you pay more for a Class A neighborhood, you pay less for a Class C neighborhood. That's the same thing right now. It's going back to those trends. If you have a property that's in a non-desirable location, you're going to need to buy that cheap at that point. You're going to need to go for a much bigger return. If you have a very special property, you can still buy that at a little bit slimmer margin. So use the traditional investment analytics and how you look at things, and you can make your adjustments from there. But don't be buying at the same numbers you bought at before. It's just, you're not going to make money that way. So increase your returns. So where are the opportunities at? So single family heavy fixers, there are buys there. If you want to put in the work and you can control your construction costs and you can work through the permitting issues, the deals have gotten substantially better. We are looking at pricing. I mean, there was a house I bought a month ago, and I paid probably 2016 pricing on this. And this was a house that was listed on market. This wasn't an off-market steal of a deal. This was something on market. They could not get any traction, and we wrote the offer that we knew was 100% safe. They took the deal. The deals are out there. But the heavier the fixer, the better margin that you want. Developer land, there's a lot of opportunity. We were just looking at a property that was listed on market today for 600 grand. It doesn't really pencil as a flip, but we see the value there because you can keep that on a long-term hold, because we were trading that dirt at about 900 grand 6 months ago. So we've seen about a 35% fallback in pricing. That also has created a lot of opportunities in those areas. We've seen more inventory and more deals in Bellevue, Kirkland, Core Seattle. The reason being the builders have slowed down, the demand has dropped, and has caused a great discount to all these properties. So there's a lot of opportunities in that space. Small multifamily with heavy value add. The cleaner multifamily still been trading fairly well. It's trading about 10% less than what we were seeing. If it needs a lot of rehab work, people are nervous about the takedown financing and then what the perm financing will end at. And there's been very little demand for it. Because there's no demand, you can pick these up substantially cheaper. There was a duplex in Bellevue just recently that was sent to me because I'm looking. If anyone has a multi-Bellevue, please call me. I'm looking for myself. But the pricing we were looking at was 250 grand cheaper than anything that had traded in the last 9 months. Now, with the interest rates, it still wasn't working very well, but that shows the pullback, and no one wanted this because it needed so much work, and we're trying to get it for about 350 than where it was. Because it needs so much work, we want a margin in there. You should not be doing these heavy fixers for no margin. It is a substantial amount of work. It's a substantial amount of risk, and that is getting built back into the pricing. Big fixers never got traded at the same prices as cosmetic fixers, except for these last couple of years. Those returns are going to expand out. Also, what we've seen is some great opportunities. We just closed a 55 unit or 58 unit up in Everett. The cap rates have increased. We are stabilizing out around a 7 cap on that. Those are trading at a 4.5 cap. So there's a lot of opportunity in there. Also, if you have any big multifamily deals, definitely send them our way. Kingston, West Pierce County, we're still buying. So the returns are there. It's about putting the right plans on these plays. But those are the 4 classes that we're really aggressively going after right now. The ones with the biggest pullback. So things like heavy fixers, we've increased our margins by 10%. Developable land, 35%. Again, all these opportunities, all these areas that had a sudden drop off in demand are getting overcorrected, and we're able to pick them up on very good pricing. So just because the market's a little shaky doesn't mean the opportunities aren't there. The pricing is substantially less than what we were paying 12 months ago. And if you believed in the market 12 months ago, you can adjust your numbers, build in the right rate, talk to your mortgage company, look at doing 5-1 arms on the short-term bridge or interest only, and get your cost down. And in 1 to 2 years, when rates fall back, and I'm predicting they're going to come in about 2 years, we'll be back into the high fives. If you run your pro forma and you look at what that cash flows at today's rate versus a 5.9 rate, it exponentially explodes your cash flow position. So right now, what we're doing is we're tracking down multifamilies that just basically break even. I really don't care about the cash flow right now. If I can break even on that deal and it's in the right location with the right upside, I'm going to hang on to that deal for 1 to 2 years, then refi it, and then increase my cash flow by typically, I'm going to pick up about a 30 to 40% gain on my cash flow position. So you guys, we're going to open this up for questions. I do want to make sure we do that. A lot of good ones already in there. So if you want more information on the trends and what you want to, for more just market information, you guys, knowledge is power right now. Like I'm listening to all sorts of different types of podcasts, different types of educational, just speakers in general, because I want everyone's opinion. So then I can formulate my own. I'm never going to take someone's exact opinion and make that my own. I want to listen to everybody, come up with my own game plan, and then adjust accordingly from there. So ways that you can do that. Check out the On the Market podcast on Bigger Pockets. Also, we do a ton of free education on our YouTube channel at Project RE, or follow me on Instagram at jdaneflips. So what we're going to be doing is we're opening up the chat. If you guys have any questions, just go ahead and fire it right in the chat, and we will answer these questions until they're done. What's up, Wally and Ludamere? See you guys on there. They're grinders, getting some deals done. Question, it says the 1% in Pierce, do you have a separate data between SFR and multifamily? We did not pull that out. We just kind of went over median home pricing to show the trends at that point. For what I'm seeing in the multifamily space, so we have a 1031 exchange buyer right now. Yes, and you guys, if you have any 2 to 4 units, clean condition in Kingstone, Pierce County, please send them my way. We have a couple 1031 exchange buyers right now that need to place money in the next 45 days. But we have seen, like we were looking at a couple duplexes on market in Spanaway, parts of Tacoma. They're about 10% off of what they were trading for right now. We're also going to hit them for about another 5% off because the rates just justify that. So I'm thinking in the small multifamily 2 to 4, we saw really accelerated growth in South King and in Pierce. We're going to see about a 20% fallback off that number, in my opinion. Seattle Soccer's dad says, James, do you see rents softening or even dropping in 2023, and by how much? This is a great question. And you know what? I will make sure we put rent predictions in this forecast. Definitely we should be doing that. Again, we just have a limited amount of time. Yes. So what we're seeing on rents, actually our rents, you guys, our collections right now in our portfolio, we're at like 96% collections. Things are still leasing up fairly quickly. We have not seen much movement, and I think it really depends on what market that you're in. Those kind of core neighborhood markets where you're kind of more in the middle. Like a lot of our product is renovated apartment buildings. We take them down to studs, we make them really nice. They get all new caps, all new floorings, a great place to live in a good location. But it's still affordable because the brand new construction buildings, their rents are a good 20% higher than ours. And so what's happening is people are opting not for the new construction, and they're kind of going into that second tier for affordability, and we can still offer them a very nice place to live. And so we've seen not a whole lot of rent movement in those. Areas like I've seen, like in parts of Pierce County, like in the single family space, we saw roughly 35 to 40% increases in rents in a 12-month period. Like I was seeing very small houses in Pierce County rent for like $2,500, $3,000 a month, which is a really high number. I feel like that asset class is going to pull back a little bit more at that point. So what I would do if you're worried about, rents are going to be more based on location, where the job growth is. I think stuff closer to infill in city, those rents will stay a little bit higher. The luxury end, higher in rents, I do think those are going to compress back a good 10%. But look at what the trend was. If the last 12 months jumped up over 30% in rent growth, 35%, be cautious of that market. A lot of other rent growth areas only went up 15 to 20%, which is high, but that was also a little bit distorted because we couldn't raise rents all throughout COVID. So there was a backlog of increases that needed to be done. So if you're seeing that 35% growth, be cautious, maybe build in like a drop of 5 to 10% in those. If you're seeing more steady 15 to 20, I think it's going to be more stable at that point. When we were renting property in 2008, we actually got the rent numbers we thought almost every time, but it just took longer to rent. So other things you might want to build into your metrics is just a little bit higher dead time on the releasing. But just like housing and appreciation, the markets that we've seen drop the fastest are the ones that skyrocketed the quickest. Like Bothell had like 35% growth over a 2-month period. We've seen that drop down quite a bit. Areas like Capitol Hill, they had more steady growth. Those prices aren't dropping as quick. And so same thing when you're looking at rents. If they haven't jumped, you're probably going to be okay and it should be more stable. Ivan asks, which neighborhoods in Seattle and Eastlake are holding values best? Which have you seen the most drop? So areas that I've seen, these core areas, Central District, Capitol Hills remain fairly strong. Parts of Ballard have good neighborhoods, and the good sections of Ballard have hung pretty strong. Where we've seen the most about a pullback are these secondary markets. So markets like Bothell's just gotten hammered. It jumped so fast in March. We were selling, I mean, a good example is we sold 4 homes in the same neighborhood, basically the same neighborhood, for 1.4 to 1.5 million in Bothell. We have a home listed at $1,050,000 and $1,001,000 in that area, getting low showings. And so the reason being is there's a lot of tech buyers in there. The stock market has gotten beat up quite a bit. It's down, a lot of these tech stocks are down 20, 30%. In addition to cost of money is up 40%. So it's double pinched that demographic in that area. And so that's why we've seen more pullback in the secondary markets. The secondary markets is where those like newer tech, the newer tech employees that were like 150 to, I'd say 125 to 200 grand a year employees, they're seeing the most they're the ones getting beat up the most on the rates. And so those are pulling back. So be cautious. The North Kirkland, Bothell, Linwood, even Shoreline in some sections, those core areas, Capitol Hill, those have hung a little bit harder. I would say, again, just like I was talking about the rents, watch the trends. If the specific neighborhood didn't jump at 25 to 35%, those are getting beat up less. So you can kind of look at what the historical 6-month average was. How quickly did it grow? If it dropped down, that's where you make your big adjustment. If it's been more stable, you can factor in for less of a depreciation. And the one thing is on Bothell and these areas, a lot of these have hit the major jumps or drops already. So we're seeing more of like a very slow, steady decline in Bothell rather than that big jolt. So a lot of the big jolts are already built in. If you have not seen much movement in there, those are the ones I'd be more cautious of. Andrew says, are you still continuing with your new construction projects? Or have them on hold? We are continuing, Andrew. I think we're building about 50 units right now. We just keep pushing forward. So, a lot of the stuff's in permitting too. The good thing is we'll probably pick up some construction costs at that time. And then also, you guys, right now, I still think we're in the thick of it to where the rates are not stable. And that's where the buyer demand has fallen. If we're building townhomes and they're coming to market in the next 6 to 9 months or even 12 months, that's where I think rates will be a lot more stable and there's going to be a lot more movement in the market. So it's not a bad thing on those new construction projects because I think we're going to get more movement on them. Luis says, good morning. Why do you think some builders like Thomas James are offloading their projects and haven't even broken ground on? You guys will, because people are business people. There's a difference in investors, right? There's guys that are just doing this to make some money. And then there's also people that run this like a professional business. Every business takes inventory on what they have, right? What do they have? Is it profitable? Is it worth doing? If they bought a project and after 9 months, the market changed and the cost of construction went up and it doesn't work well for their buy box, as an investor, it's better to just get rid of that and go buy stuff that you want to buy. If I have product that my guys are not good at building or remodeling, I'm not going to want to buy that deal. I want to buy the stuff that I'm really good at because that's how I can actually make money in this market. So a lot of people are just taking inventory and doing the responsible thing and get rid of what they don't want of. All my flips that I'm going to market with, I'm getting those things sold. I'm not really worried about the profit on them because I just want to get liquidity back and reset all my buying expectations and reset my pipeline. As investors, we always have a pipeline going, whether it's buying another rental, buying another flip. You have to manage that pipeline. If it goes bad, then get rid of it, dump it, reload the stuff you're good at. You'll make more money that way. Luis also asks, and what are your thoughts on, sorry. on cottage developments the next big thing, or is SF lot single family dadu? I'm seeing SF ADU dadu podcasts sell really well, like in Ballard Green Lake. Yes, you guys, you just got to know your product, right? If you're building a dadu and all the comps have a yard or a driveway and yours doesn't, you're going to sell yours for 15-20% less. And I think that's a big mistake that people are making is they're not looking at the negative impacts on some of these things. Those daddies do trade really well if they have the space. If it's all off-street parking, that can become an issue. And so you really want to know what you're actually building. The reason off-street parking has become more of an issue is because it comes with more hair, right? Someone has to park on the street. They got to walk through rain to get to their house. Also, they can't get a charging station there. And those are things that hold people back from buying. People will still buy it. They just want to buy it cheaper. So you just really want to dig into how good is your site and kind of then evaluate it from there. If you have negative things about your site, knock the values down 10-20%. Then buy off that number. If you have a good product, then be comfortable with what you're building. I do think there's a tremendous amount of opportunity in the cottage RSL in small spaces. And the reason being is the big builders are trying to clean up their inventory right now, and they're not buying right now. And that's where we're seeing dirt pricing down 35% in a very short amount of time. And so if you have the right processes, the right money ready to go, and you can build it and you know what your build costs are, there's great deals out there. I know we're chasing those right now because, I mean, anytime I see a 35% drop, that's an opportunity there. And these are homes that are in good locations, good areas on good lots, and they will be worth money down the road, or you're buying them so right now you can actually absorb the debt cost on the resale as well. Um, Another question from Mark says, following up on Emily's question, what is your ideal source percentage if we bring you a deal? Do we also get the list backs? Oh, yes. Yeah. If I buy a property, I'll always list it back with you. And that's you guys, that's a loaded question. What is your source? What is your deal source percentage if we bring you a deal? Are you asking what my returns should be? Or do we buy, how many deals do we buy when they're brought to us? You guys, that is a loaded question if it's about margin. Margin is dictated based on effort, time, and what you have to do there. A lot of wholesalers and brokers have thrown all these deals into the same box the last 3 years. That doesn't make any sense. It only made sense because there was no product out there. If you have a beat up home that has permitting issues and other negative factors on it or things that are going to cause delays, I'm going to expect a massive return on that. Why? Because it's a total pain in my butt. It takes forever, and there's a lot more risk in that deal. If it's a cosmetic deal, I'm going to buy on a much thinner margin. Typically, what we're buying on, though, on cosmetic deals, we're buying about a 17% cash on cash return, which equates out to about 30 to 40% with leverage. On a big fixer now, though, I want a 20 to 25% return, which is going to be about 50 to 60% on cash to cash. The reason being, it's going to take me a year, not 6 months. It's twice the deal is what it is going to be. In addition to, they're harder things to control right now. Construction costs are still really high, and the most expensive items are the mechanicals. So the ones you have to rebuild, those trades are still in high demand. We're getting breaks on painters, drywallers, flooring installers, but not the core subs. So there's less movement in that space. So you really got to look at what asset class you're working with, what property you have, and then what's the annualized return, and then we can get you a number. But no deal should have the same number on it. And you guys, try to stay away from mass marketing and putting everything in the same box because that's not real estate in general. Again, that worked the last 2-3 years. That it's probably now over that way. Look at what the deal is and make your adjustments based on there. There's such an important piece of wholesaling that if you put that wrong number on that deal, it's going to go stale. No one's going to buy it. So you got to make sure that it is a good opportunity for people, especially right now. There is, like we were talking about, transactions are down 40 to 50%. In the investment fix and flip space, they're down like 70%. And that means so there's very low buyers. It is risky to buy a deal right now. It better be a good one. Another question. Lots of questions today, guys. These are great questions, by the way. Do you follow the STR market? Seen an impact there? Yes. So what I've heard, and you guys, STR is another thing, just like kind of what I was talking about. Everything can't fit in the same box. If you're looking at short-term rentals, that can be a great thing. I personally, because it can give you a great return, I personally underwrite every deal as a traditional rental, and then STR is the upside. One thing that we have seen is, from what I've heard, that STR bookings are down 60 to 70% this year. I don't know if that's a true fact or not, But if we go into recession, people's disposable income goes down. And that's where STR could shrink backwards, just like all of us, fix and flip development. The margins are going to start to shrink back. I would say just evaluate it as a regular rental. If the deal makes sense that way, buy it, and then you can do STR and make your higher return. You should be making a higher return with STR because it's a lot more work. Also, make sure that you have the right processes in play, because if you have a bad short-term rental, you're going to get a bad rep, and it makes it very hard to lease it up. Jay, what's up, buddy? I owe you a phone call on cabinets. Oh, by the way, guys, Jay Gagnon, they own a very good cabinet shop down south. If you need referrals on cabinets, I would call them. They can get you a really good line, all different budgets. So check them out. And there's great people. We've known them for 10, 15 years. And then Mark says, if we bring you a deal, do we get paid upfront commission is what I mean. Oh, yeah. Yeah. Mark, if you bring us a deal, what we do is we just tell you the number that we can pay for the property. And we'll give you all the logic behind it, our flip calc, our budget in that. And then if you go get it below that number, we'll pay you the variance. So for us, we don't really care how big your fee is. I mean, I think there's a few guys on here I paid 50, 75, 300 grand to on fees. We're totally good paying big fees. We just need to make sure that the deal makes sense for us. Nick says, what do you think of Houston County particular? Oh, Houston County. Nick, I don't know where Houston County is. Particular Federway or South King, maybe. Particular Federway, Auburn, Kent, and Des Moines. It depends on the areas. We've actually been still moving things fairly well in those price points. If you're in the upper echelon, like 700-800 or above, those could get beat up pretty good. But the stuff that we're selling in that I would say 450 to 550 range, we're seeming to be moving fairly quickly. It's still somewhat affordable. But then dig into the locations and streets a lot, because those specific areas have a very big mixture of neighborhoods. And again, for the last 24 months, the mixture of neighborhoods didn't have the impact it used to have. Now it is. And so just make sure you're using like for like comparables inside the same type of neighborhoods with the same schools, the same feel, whether it has sidewalks or no sidewalks. And then you should be able to narrow that value down and hit your ARV. Edgar asks, please talk a little bit about loan to value rates, LTV rates, terms, longer hold. What is EasyButton leads? Good question. So EasyButton leads, guys, if you guys are wholesalers or investors looking for more deals, it is a call service for very cheap. I think it's about $1,400 a month. You can get a professionally trained caller reading off scripts, targeting your ads or targeting your sellers. What this has done, we used to not do stuff like this through our off-market company because the market was so hot, people weren't responding well. Now, because of the economic conditions and what's going on, there's uncertainty. You don't know when someone wants to sell or not. A lot of the sellers that we've been able to get through EasyButton leads and mass manufacturing calls is getting in front of people that would not show up on a traditional data list. It gives you that just random opportunity. We just actually inked up a deal that came from EasyButton leads that I think there's the investor's getting a screaming deal. It's like a 24% return, and there's a 50 grand in fees on there. And so how we did that, we just called the person at the right time. He had a bad tenant. They said, yes, it's trash. I want out of this. They gave us the number and we signed it up for that number. So just get in front of, as many sellers as you can right now. Loan to value, LTV. Please talk a little bit about LTV. I'm not in what regards. And right now, you guys, you want to target being like 70% of loan to value on your BRRRR properties. Loan to value on your buy price versus your exit price doesn't really matter. Like when you hear 50 cents on the dollar, it really doesn't matter. It matters what your all-in numbers are. If you want to look at loan to values, you want to be probably fix up plus purchase price plus debt cost around 70% of value right now, 75%. All right, guys, all good questions. We've gone a little bit over, which is typical for me. I will leave it open for another 30 seconds for questions. And you guys, to be honest, is a great market to be buying right now. And I'm not saying that because I'm a real estate broker. I'm doing that because I'm saying that because I just bought a substantial amount of property. The best thing that you can do is narrow your buy box and find out what a good deal to you is in this market. If you know what a good deal to you is and what your expected returns are, that will dictate whether you should buy or not. And if you're really freaked out by the market, then make it a big return. And if you have the right systems in play and you can be aggressive, it's a great way to get a competitive edge above everyone else. So just really narrow that buy box, figure out what you're good at, put that number on it, and then still look at deals from there. I keep hearing guys are like, I'm going to sit it out for 12 months. I'm like, why? You know how hard it is to get back in the game after 12 months? I mean, the best thing I've heard is the competitors are taking a break right now. I'm like, all right, well, I'll never see you again because it's hard to get. This is a high speed market. If you're not in the market all the time, it's hard to get back in it. So it's don't take a break, adjust your numbers. If if you're really worried, then ask for ripper deals. And if you'll eventually get one, I promise you. Um, Another question is, oh, wait, here we go. Lots of questions. Tony asks, are you targeting projects where products require jumbo loans due to better interest rates on those loans or not necessarily? Not necessarily because we're using such recent comparable. We're just going off the math size. Jumbo rates are good because they are cheaper. But it's not really where we're targeting. We're targeting things that I like to go after is stuff with lower inventory where I can talk to brokers and they're getting good traffic. Like I'm going to be cautious if I'm calling 5 brokers in an area and they all had one showing. That means not all buyers there. But like we listed that property in Bellevue and Tamashana recently. We get 7 to 8 showings a week. That's high for what we're got going on. There's a good buyer mix for that neighborhood. So I will look at more deals in that neighborhood. People want to live there. And so I would say just really talk to people and target where the activity is, not just where the rate is. Um, I did think about starting to flip a lot of duplexes though, because I think that affordability factor will help on that. Ivan has thoughts if Seattle will get hit with tech layoffs. Most of the clients are tech, and their settlement is low. Most are stressed about being laid off. Yeah, that's you guys. That's a real thing. These tech companies. I mean, I go off of just what people tell me. There's and what they're saying is they're going to lay people off. Um, and that means, yes, the job market will shrink. That means the stocks are probably going down even further a little bit. And that's okay. You know, you just need to adjust who your clientele is and then also you can target different types. If you're really worried about tech, I would target markets that are like resale 4 to 550. That's usually blue collar workers, not tech. But at the end of the day, there's still a substantial amount of jobs here. Amazon has bought a substantial amount of land. Facebook has bought land. Google is building out Kirkland. These tech companies are rapidly expanding through Seattle because there's no income tax here. And it makes them competitive against companies across the nation, right? They were all in San Francisco forever, and that income tax became an issue for them, right? People don't like giving away 13% of their money every month or every year. Um, and so they put so much infrastructure up here, or they're working on so much infrastructure that our tech market is going to be very stable for the next 5 to 10 years. I would be more worried about San Francisco than Seattle because they're getting double pinch, right? Cost of housing is high, their income tax is high, and tech layoffs at that point. We have a lot of growth built in. And, for us, this is a long-term play. And we know that the economy and the tech space is going to be more expanded over the next 5 to 10 years in Seattle. Oh, the other thing is about tech too. You know what they're getting rid of? Work from home. A lot of them are saying don't work from home. I'm a firm believer of that. You should not work from home. You need to be in office to be productive. But what does that mean? That means people that were further out that maybe moved to Bend, Oregon, or all these other places where they want to get out of their tech job and their daily grind, they have to come back to the city. That means they're going to need housing at that point too. So there is some silver lining in that as well. Mark asked, how do you reach you if you have deals to present you? So the best thing you guys can do is email my assistant, Naomi, at heatondainard.com. You guys, if you send us a deal, we'll try to get you numbers back within 24 hours. We may have some questions. If you can send us as much information as possible, photos really, really help us in our strike price that we're offering. We can underwrite really well off rehabs based on photos and historical averages. So more information, the better number we'll get you. All right, guys. Well, we are hitting, I went way over. We're about 30 minutes over where we're supposed to be. So we'll probably wrap this up. You guys, we will be back on next month. I'm going to build a couple more metrics we're going to review next month. We'll probably go over rent growth, kind of rent trends at that point. we're going to dig a little bit more into the forecasting and what other people are saying for the next 2 quarters. And so I think we've summed up the first half enough over the last 4 months. We all know it was really good, and now it's not. And so we're going to go into really the forecasting of what we're going to be doing, what we're looking for, and why we're looking for these things based on what professionals and experienced investors are doing. So we look forward to seeing you guys again next month. Also, you can share with a friend if they want. Anyone can come. And Seattle Soccer Dad's Chris Savage. What's up, buddy? We haven't spoken in a while. Good catching up. Or I guess we didn't catch up, but good to see you. And the next one will be on December 20th too. So right before Christmas. Wear our Santa outfit. So I want to thank everyone for coming out. Again, check out the On the Market podcast through Bigger Pockets. And if you guys have not came to us, you guys were doing in-person meetings back in the office for the Investor 101s. Come hang out with us. And we look forward to hanging out.